So let's get started talking about RSI, Relative Strength Index. It's one of the world's leading and foremost used trading indicators. Now, RSI is a momentum indicator developed by a technical analyst named Wells Wilder and was published in his book New Concepts of Technical Analysis in 1978. So that was almost 50 years ago. So that means it was before CFD trading, before forex trading, and before online trading. And it's still used by all of these people trading all of these industries today because it is such a dependable indicator and it works well in all markets. So without going too deep into the workings of RSI, it is primarily used to an attempt to identify overbought or oversold conditions when trading an instrument. Now, what we have to remember is overbought and oversold are not the same as buy and sell. An overbought market can remain overbought. An oversold market can remain oversold. So think of these as indicators that tells you the market is getting too heavy, and if the market's overbought, it is getting too heavy, it will eventually flip back down. It's showing signs of flipping back down. So think of it as a rocket. And this rocket shooting up into the sky, now we know eventually that rocket is going to turn and come back to Earth. But we can also watch for when that momentum taking it climbing into the air slows down. Now we can't really predict the minute that rocket's going to flip over, and it can keep going up and keep going up, but we can see the momentum easing. So we know that it is about to flip back to Earth. So RSI falls into the area of a oscillator. So we have our whole field of technical analysis, and in this field of technical analysis, we have what's called technical indicators. And of these types of indicators, we have a certain group that are called oscillators. An oscillator is a technical tool we as traders use to give us indications of whether an instrument is overbought or oversold. We use these overbought and oversold extremes to see in which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis indicators to make decisions on entering trades. There are a few oscillators like RSI, ROC, MFI, and tonight we're going to be discussing the most popular, and that is RSI, Relative Strength Index. Now, RSI falls into an even more restrictive category called bounded oscillators. Bounded oscillators are indicators that are bound by numeric values. So RSI will always oscillate between the 0 and 100. Not 101, not 104, not -1, always between 0 and 100. Now, traditionally, and according to Wilder, RSI is considered overbought when it moves above the 70 in its calculation and when it moves below the 30. Now, signals can be generated by looking for divergences, failure swings, and center line crossovers. RSI can also be used to identify the general trend. So before we talk about the calculation, let me pop one up on a chart, and we're going to look at what this is so you know what we're talking about. So RSI is placed on the bottom of your chart, underneath price action. Now, you don't have to do any calculations. You don't have to do anything. When you go up to indicators, no matter what chart you're using, and I'm going to show you a little presentation on how to do it on the ETX Trader Pro platform shortly. But doesn't matter. It's going to drop this on to your charts. It's going to use a 0 to 100 automatically. It's going to give you an area that is between the 70 and the 30. Now, you can call this dead man zone. A lot of people don't use this area between the 70 and the 30 to do anything with RSI. But it tells you a lot of stuff in that field. But the signals generated by RSI or above the 70 is overbought and below the 30 is oversold. Now you can, and a lot of people do, modify the RSI, and you can make them 80-20. By doing so, it widens the field that is not important in the overbought and oversold calculations, gives you less signals, and it gives you fewer signals, but much more distinct. RSI is one of the few indicators that you can very easily customize. So, but the standard is 70-30. And almost all the literature you read will talk about the 70-30. Now, there's there's huge amounts of literature in the internet on RSI. Now, some of the gurus out there pushing their own strategies will be talking about 80-20 or 75-25. Now, remember, these are customized, but it's not a freak out thing. It's not. There are certain indicators, like you see people taking MACD and changing it all around, but then it's no longer MACD. RSI can easily be adjusted to a higher or lower level. Okay. Because it just tells you the number and the calculation remains the same. It's just the area in which you're going to use its signals. But this is RSI. Okay? Plain and simple. Now, we've learned how to put it on our charts. Let's talk about, first, where this number comes from that is put on your chart and what it means. Okay? Because you have to understand the basics before you can actually go out and start risking your money and trading with these things. So the calculation for RSI is a very easy calculation. It's 100 minus 100 divided by 1 plus RS. Okay. RS is the average of days when the instrument closed up or closed down. Now, I have a real quick presentation that's going to explain this to you in an easy detail so you understand it, but we'll never have to go back to it again. So let's watch this, and I'm going to explain it to you here. So that wasn't so complicated. Okay. Now, the standard look-back period that was originally, and is still pretty much used for Wells, is a 14-period look-back. So when we talk about days, we're not going back. It depends on your chart. If you're using a one-day chart, you're going back 14 days. If you're using a 1 hour chart, you're going back 14 hours. It would be the last 14 marks on your chart. We've found over time that the look-back period, especially for forex trading, is better at a 10-period look-back trading. Because the forex market moves so quickly and in very small increments of pips. But if you're looking at CFDs for stocks, you would stick with the 14. Now, the thing is, you can customize these, and you have to kind of figure out what is right, because cryptocurrencies would be completely different for the look back period. The longer the look back period, the more data that's in there. It really doesn't change the overall calculations, but the more look back period, because when you're using a very short chart and you're using a 10 period look back on a 10-minute chart, you're only going back 10, 14, 10, 15-minute period. So you're only going back the last 2 hours. So sometimes that isn't enough for you. So you have to use it in combination with the chart that you're looking at. Now, taking the prior value plus the current value is a smoothing technique similar to that used to calculate an exponential moving average. Advanced charts use at least 250 data points prior to the starting of date of any chart, assuming that much data exists. So when calculating its RSI values, you can go back 250. You can say use a look back period of 250. That's way too far back. So Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. In fact, a plot of RS looks exactly like the plot of the RSI. The normalization step makes it easier to identify extremes because RSI is range bound. RSI is 0. Okay, and this is what you have to understand. RSI is 0 when the average gain equals 0. Because anytime you have an average gain of 0 and multiply it, no matter whether you're multiplying it by a 10 period, 20 period, 30 period, it's always going to be 0. Any number multiplied by 0. RSI is at 100 whenever the average loss equals 0. So this is how you get the extremes, but because it really never makes the extremes, because you're never going to have 10 or 14 periods that have had no gains or no losses. So it will range as high as I've seen at 99.9. I've seen it as low as 1, but very rarely does it ever get there. Now, the default look-back period for RSI is 14, as I mentioned, but this can be lowered to increase sensitivity or raised to decrease sensitivity. 10-day RSI is more likely to reach overbought or oversold levels than a 20-day RSI. The look-back parameter also depends on a security's volatility. A 14-day RSI for internet retailer Amazon is more likely to become overbought or oversold than a 14-day RSI for, say, Duke Energy, which is a utility that doesn't move much. So RSI is considered overbought when it's above 70 and oversold when it is below 30. These traditional levels can also be adjusted to better fit the security or the analytical requirement. Now, one of the reasons that successful traders don't trade a million assets, and if you ever came to our class on building a trading plan, I explained to you that you should take one field. Don't jump from cryptocurrency over to stocks, back to indices, back to currencies, back to the euro, over to the pound, because you cannot become a master of all of these. Now, some of us use very specific strategies that have nothing to do with the asset itself because you're looking for a specific pattern. That's a different story. But overall, you should be an expert at the assets you're trading. And what will happen is you'll find that if, like, you're trading the euro, US dollar, the euro pound, you could trade any of the euro crosses and still have a full range of other things. But you'll eventually see that maybe the euro pound very often moves up to overbought. Okay. And it comes often up to 82, 85, 87. So you might say, okay, 70 is too often broken. So let's move the range up to 80. You don't have to change anything. You can just put it in your head. You'll also see some assets, for some reason, they always seem to reverse course at 96 and 97. Okay? Because you've studied your assets enough and used the RSI charts enough that you understand what these are. So raising overbought to 80 or lowering oversold to 20 will reduce the number of overbought and oversold readings. Short-term traders sometimes use 2-period RSI to look for readings over 80 and oversold readings below 20. Now, since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to nearly any market. However, it is commonly applied to the more liquid and larger markets like forex, stocks, and commodities. So in a downtrend, RSI can be oversold. In an uptrend, RSI would most likely become overbought. Now we can use the center line to determine the market direction. So in other words, if we say 50 is the center line, and whenever we see RSI crossing from 40 up to 50 and crossing 50, we know that market is trending up. If we see RSI, say at 60, falling below and going below the center line of 50, falling to 40, we can then know the market is going down. Because trading on the right side of the trend is also very important. So when selecting the indicator to your charts, you will be prompted to change the parameters for RSI like I showed you. I would suggest that new traders keep it at the default setting of 14A as your period, and this is referred to as the last 14 trading days or trading periods. So you'll see an RSI value of 70 to 30 across your indicator, and the RSI moving above 70. This is an indication that the instrument is overbought. Below 30, oversold. When these trend reversals happen, we want to get into the market and ride the trend as long as possible, and preferably until the next trend reversal. So what we would do is we can put a line across at the 50 line. Okay. We would look for overbought conditions over this 70. We look for oversold conditions at below this 30 line. When we see the mark, we see the indicator coming up this way and breaking above the 50. That tells us, because we can see we have an uptrending market, but this tells us we're definitely in an uptrend. When we see it come down this way and break below that 50, we know this is not just a retracement. We know we've moved into a downtrend. Same thing here. When it moves above, we've now moved into an uptrend, not a retracement. So let's talk about how we would use this indicator with our trading. Now, RSI is used in a number of ways. 3 popular functions are overbought and oversold, RSI ranges, and divergence. Now, all the time in media and analysis, we'll hear this stock is overbought or this asset is oversold. This is usually because the speaker's talking about the RSI reading. So unfortunately, it's not as easy as buying when the indicator moves below 30 or selling when the indicator is above 70. Okay. This is too simplistic because it pops up and down all the time, above 70, below 30. Okay. It's just telling you that that trend is losing its momentum. We need to look for other pieces of information. And we can apply this. Divergence works very well. Reading your candlesticks and divergence works very well. But we need to combine it with other indicators. So I'll show you on a quick chart here. Let me pop up a chart for you. Here's a chart for Bitcoin US dollar. Now we see that Bitcoin is moving in a downtrend and we actually have a wedge forming. Okay, that might be going in a triangle, but we have a beautiful wedge. And then we got the breakout. Here we got the breakout. Now, what do we have? We have our RSI on our chart below. And when it broke out, we also got the surge that it was telling us the market was overbought. Okay, I'm sorry. When we got the breakout here, the market moved above the 50. So we saw it moving into an uptrend. Okay. We hit a bottom here, so we hit the oversold. And now we've had the surge all the way up to here. And look at that. It hit our target price at our very specific resistance level and is also telling us now that the market is overbought. So what we're expecting is the market to turn down at this point. So this was our number one target. We have our Fibonacci levels on here, and we saw that it moved up. It's moving up to our 38.5. We had the breakout of channel, and we had RSI in our overbought condition. And in this case, we were using three pieces of information. Our wedge, our channel wedge, okay, our breakout, our support level, and our resistance level. Okay, all of this and in conjunction with our RSI. And I've got it in white, but we also have a wedge pattern forming in our RSI that coincides with the wedge up here. So we had a whole bunch of information going on using our RSI. So when a buy is triggered, a stop is placed below the most recent swing low. A sell signal is used to exit long trades or initiate short positions with a stop above the recent swing high. Okay, so we can see the swing lows and swing highs of the RSI, or the breaks above the 50 and below, and the breaks in overbought and oversold. And then we can use our candlesticks to set our stop losses. But we can use, in this case, okay, this is with a stock, and it has to be this stock doesn't go above 70 and below 30 hardly ever. So we've adjusted our levels for this particular stock to 65 and 35 because this is what's fitting for this stock, or historically what works well for this particular asset. So I'm going to pop up a presentation I prepared for you on using RSI to trade forex and cryptocurrency. And then we'll come back after the presentation and we're going to go see how to do this on ETX. So as you can see, there are many ways that you can use RSI in your trading. Now, just a side note, tonight is our last webinar of the year, and we'll be back with you in, I believe it's January the 3rd. And they're posting the calendar now, but it's either the 2nd or the 3rd, but I think, depending on what days it falls. But the first webinar of 2019 is a brand new class on understanding divergence. Because a lot of traders have a difficult time understanding divergence, not RSI divergence. Almost every indicator you use has an interpretation of divergence. So whether you're using a momentum indicator like RSI that gives you overbought and oversold conditions, or using MACD as transaction signals, okay, or you're using some other indicator, they all have divergence. And spotting and finding divergence and how you can incorporate it in your trading is very, very important. So our new class starting, and its first class of January, is called Trading Divergence. And we're going to look at divergence in almost all the different indicators and how you could apply those and how you could use them in your trading decisions. But getting back to RSI. RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong, whether it's a strong uptrend or downtrend, the indicator can stay in the overbought or oversold territory for a long time. Therefore, price analysis and some other confirmation is needed for reversals. The same is true for divergence. While the RSI may be dropping and price rising, that doesn't mean the price will drop soon. The RSI is just showing that the price is moving higher at a slower pace. Remember the rocket that it was before. Confirmation of reversal is still needed, such as swing lows, a swing high or lower swing lows in the price movement. RSI ranges can help confirm trends, but each stock or market will have slightly different levels, as I mentioned to you before. One stock may repeatedly move to 38 on pullbacks, while another one may go to 33. Therefore, some adjustment is often needed for each stock or each market, since a one-size-fits-all approach may not necessarily work. So let's go over and take a look at how we would put RSI on the ETX charts so that you can incorporate it directly into the trading platform. It's very easy with our ETX trading platform, and we'll show you how you can put them on the charts as well as adjust them. So as you can see, putting RSI as well as other indicators on the Trader Pro platform charts makes it very easy. And now that we have the ability to also trade directly from the charts and adjust your stop loss and your limit orders directly from your charts, now you can do everything in one place. Okay, so our advanced charts are now very, very easy to use, and you can make them, customize them to be any which way you want. And of course, you can open them up for full screen viewing so you're not looking at these little tiny charts. Now back to RSI, Wilder suggests that divergence between an asset's price movement and the RSI oscillator can signal a potential reversal. The reason is that in these instances, directional momentum does not confirm the price. A bullish divergence forms when the underlying asset makes lower lows and RSI makes higher lows. RSI divergence from the bearish price action is that it shows strengthening momentum, indicating a potential upward reversal in price. So, as with overbought and oversold levels, divergences are more likely to give false signals in the context of a strong trend. Okay, so we have to understand how to see failure swings, and we have to be able to adjust our levels from that 30 and 70 and not use them as concrete and make our trading decisions just from those levels. But a failure swing, in this instance, RSI moved from 70 into overbought territory if it then moves back below the 70. So in other words, what we see is price pushing up, coming down and breaking that 50, touching that 50 line, bouncing back up, trying to recover, and it can't, and then it falls back below that 50 line and moves down. So it failed to make the new high. So there's many ways that we can use RSIs. Okay, we have to learn how to use them and how to see them, and we have to decide which is of value to us and which we would use in our trading decision. But you need to think beyond just crossovers. You need to think of beyond 70 and 30. You need to learn how this oscillator is talking to you. So when traders first learn about RSI and other oscillators, they tend to gravitate towards overbought and oversold values. While these are intuitive points to enter into a market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for a long period of time. So always keep an eye on the center line. All oscillators have center lines, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different. A center line found in the middle of the range of 50. Technical traders use that center line to show shifts in trends. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy into that market. A drop below 50 would indicate a development of a new bearish trend, and we might look for that trend to reverse. So always keep an eye. One of the best reasons to use RSI is to use that center line. So the bottom line is that RSI is popular because it has multiple uses. It is used to find entry-exit signals based on overbought and oversold readings and trending ranges, and can also help spot or confirm reversals via divergence. Like any technical analysis tool, though, the RSI is prone to providing false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. So, thank you very much for joining us tonight. Thank you for supporting ETX throughout the year. And as I said, we're going on holiday, and we'll return the first Tuesday or Thursday after January. I don't know what day the first is falling. Actually, I can figure that out real quick. Okay. New Year's Day is on Tuesday, so our first class will be on Thursday, the 3rd of January, and that class will be the new class on trading divergences. So we'll see you in January. So we wish you all a very happy and successful 2019. And no matter what you celebrate, we wish you the most joyous season of the year. So again, thank you very much for supporting us. And this webinar will be available to watch after tomorrow using the same link you used to come to tonight's class. So thank you very much. I hope you learned a little bit along the way and enjoy your season.